So these 4 positions that I'm going to showcase to you were missed primarily because I was asleep, and there's nothing you can do about these kind of trades. I want to make this very clear in this video. They happen all the time. In fact, irrelevant of what system that you're trading, you're always going to be missing trades, whether you like it or not. There's always opportunity in the market. The market's always moving up and down. You can't catch every single up and down movement in the market. So remember, you're going to miss trades at times. It is what it is. If you're missing trades because of psychological reasons, it's different. If you sat there looking at the charts and you're hesitating, or let's say, for example, you're pushing yourself into trades that you should not be in, and then as a side effect of that, you're then missing out on the greater quality trades because of a lack of patience, there's 2 different polarities there that you've got to work on and get to the root of, which I won't dive into in this video. Maybe I'll keep that for a separate video. Let me know down below if you would like a video on that too. If you're missing trades because of, say, you weren't particularly at the screens, whether it's because you were asleep or you're occupied doing something else, there is nothing you can review about that. So don't try and dwell on that. And I'm going to go into this video with that theme because a lot of people, again, including myself in the past, would dwell over missed positions irrelevant of what the reason was. It's very important what the reason is. If you're missing positions because of psychological roadblocks, you need to work on that. Right. Aussie 200, first position here. So what have we got here? We've got higher time frames are very simple. So we've got this value area here, as you can see. We've essentially trickled past that. Whenever price action trickles past like so in an exhaustive fashion, and it's trading between 2 major areas, whether it's the daily or the weekly, the last thing you want to do is get caught up into 15 or 5-minute entries on the lower time frame here within this, because you can get caught up into the mess essentially. Now, we can pattern separate as much as we possibly like. And remember, this is why I strictly stick to the 1 hour when it comes to this sort of macro analysis, if you like. Because what a lot of people do wrong is they overuse the lower time frames unnecessarily, and they will find patterns, they'll find entries because of a bias programming on the lower time frame. You've got to understand, because you're more zoomed in, you are going to see a lot more things. A lot of the times you can actually make more money by sitting on your hands and using the 1 hour time frame in the right areas, as opposed to jumping into the 15-minute or the 5-minute. As an example. So we've got the middle section, we've got the 1, 2, 3. We've broken past, we've got left shoulder formation, head and right shoulder. Now the reason this head and shoulder sequence doesn't hold as much significance is because it's trading between 2 value areas. If this head and shoulder sequence was placed at here, or the prior value area that I had on, it's far different. We've broken past that and formed this in the midst of both of them. So I'm not holding too much weight on that as I normally would, but it is an added extra confluence. But you've got to understand the difference again between adding confluences for the sake of it and actual weighted confluence. Now what gives this overall weight is not only the head and shoulders, but it's what goes in combination with that, which is the continuation pattern that I can see on the 1 hour time frame. So when I filtered that to the 15-minute, we have 1, 2 and 3 leading up to that. Now this would have been a limit order play. I very, very, very rarely do limit order plays, and I very rarely encourage them either. I would not encourage them to you if you're starting out, you're brand new, you're fresh, or you lack experience. This is very situational. So the reason why a limit order play would have been set here, 50% of this candle, is primarily because an entry at the bottom of this candle wouldn't have granted a greater risk to reward, and it wouldn't have been worth taking the trade anyway for that reason. So what I like to do sometimes is set the limit order on 50% of the candle. That then allows me for better stop protection, as we can see here, and also double the risk to reward sometimes. Risk to reward is a final focal point for me. It's not a primary focal point for me, but it is a final focal point, and it is on there because a lot of people don't actually realize, if you're going to get involved in trades, make sure they have the opportunity to yield you a healthy profit. At the end of the day, you want to get paid well as a trader, but you have to get done so sustainably. Don't just try and chase a trade primarily because of the risk to reward. That's got to be the final focal point, not the primary focal point. Very important that you get the order right on that one. So we have that, as you can see there. That would have been just triggered in. So as you can see, the entry would have been around 1:45 AM. I was absolutely knocked out. at that point. I'm waking up around 5:30 a.m. every day, sometimes even weekends, because it's just my body clock. So I'm not going to wait up for an entry that may not even shape up, and that's going to affect then my sleep and my state of mind for the next day. It's very important. It's very rare that I would stay up for an entry. So the reason this position was higher in risk, one tiny little reason here. When you have a structured flag, especially monitored on the 1 hour time frame, because you either have a structured or a non-structured flag, when you have a structured flag, you pay attention, especially on the time frame that you're looking at, in this case on the 1 hour, to the pin bars, to the wick fills, and all these kind of interesting details and price action that make a huge difference, that might not seem potent, but they're very, very potent, and they add up over time. Don't just look at positions like this, for example, that because of the pin bar here that we can see that closed before the edge, which again was a brilliant retrace on the lower time frames, as it always is on the lower time frames, right? They're a very manipulative time frame. You've got to know when to get into them and when to use them. So we got the pin bar here, 9 out of 10 times, a very high efficacy rate of this actually, that the next following candle fills that. Once that closes, then I'm looking on the 15 or the 5 or whatever time frame is relevant. So in this case, the only thing that would have warranted me looking past that is the 1, 2, 3 leading up to it. When we don't have that, I'm strictly waiting for the pin bar to fill, and then I'll get in on the next candle. So had I been awake, or this would have been in my particular time zone, I would have happily taken that if I could have afforded it, is the key point here. Higher risk positions for me personally are all secondarily. So they're not a primary focal point. They're not a primary priority, sorry. I always put them secondary, meaning if there is a lower risk position at stake, I will take that first and I will prioritize that first. Because the more lower risk positions that I'm involved in, that all come from the plan, the more chances I've got of performing better as a trader. Now, you waiting for low risk positions, you're not going to be in a position where you're taking positions once every 3, 4, 5 weeks. Not that frequency even matters as much as you think it does. Because a lot of traders think, oh, well, I need to have my frequency bandwidth within a certain amount, otherwise I'm never going to make money. Your frequency will change every month. Of course, every trader has like an optimum frequency range whereby they find that whenever they're trading around that many trades, that their edge has a decent sample size to play out within. And that's not what I'm saying. My point is, if you're setting a limit on how much you think is right for you, as opposed to looking at, well, what's the market giving me? And does it fit two criteria? Does it fit the plan? And also, what's the risk parameters of the trade? If you're strictly focusing on that, I don't care if I get 100 trades in a month or 1 trade in a month. It does not matter to me. I'm only looking at those 2 things to measure a trade, and the market's going to give me what it's going to give me. Who am I to judge that? So anyway, besides the point, there's a time when you can afford higher risk, and there's a time where obviously low risk is better suited. So what I like to say is that when you're up in positive, you've got the financial buffer there to be able to afford the added element of risk of taking a higher risk position. So you've got that buffer that is very important. You don't want to be taking high risk positions when you're into drawdown or deep in drawdown, etc. So this one here, crucial position, small little detail. We would have been running nothing crazy right now, about 4.9. Well, technically actually now about 4%. So I would have locked in around 2.5 above this structure here, as we can see. That's 2.5 locked in on that one. And by the way, you get many of these positions over the year. Many positions over the year. Anybody again looking at the markets now, we're only in February. And I'm not saying this, excuse me, so you can become lazy, or you can say, you know, lay back. Every quarter is very important, especially Q1. It's very liquid. But don't be surprised that Q1, or let's say even Q2, or just one quarter in the year, we can pick any random quarter, may not go the way that you wanted it to go. But that doesn't mean you're further back. That does not mean that you're further back. That could actually mean that you're further forward. For example, let's say in Q1, you made a lot of mistakes, you know, and your trading went downhill. You lost a bit of confidence. You lost your account, whatever it might have been. As a side effect of that, though, you're going to pick up on your mistakes a lot quicker. Let's say the other person who did very, very well in Q1 on paper, performed well, made a lot of money, scaled their account up into Q2, but they did it unsustainably. So they had gaps in their trading, but they didn't realize because the profits covered the gaps. You try to tell a trader who's making money that you've got gaps in your trading and tell me if they're going to believe you. And then Q2, 3 and 4, all those gaps are going to come out again and lose everything. So technically the person who made the mistakes in Q1 was further ahead than the person who didn't make mistakes but scaled their trading up unsustainably. This is why mentorship and guidance and proper coaching is very important, believe me. So euro pound, euro sterling, very nice, 1 2 3 higher time frames. The only thing that's going to confirm the change in sentiment is continuation pattern to the upside. Until then, we're still responding with this 1 2 3 break back in. As you can see, not the clearest turnaround, but we can see it on the 4 hour. We've come into this value area now, but at that stage earlier on, hence why it was higher risk, because you don't know if this is going to be pullback to form a continuation to then go higher, or if this is reversal price action. Now 7-8 times out of 10, this kind of price action here is not reversal price action, it's pullback price action because of the exhaustive momentum. However, I'm going to give euro pound the benefit of the doubt here. This is a pair that I've traded, for those guys in the community that know, so much. It's one of my, barring Germany 30 and other indices, it's one of my most favorite pairs to trade. So yeah, I know this pair pretty well, let's put it that way. As you can see, the bottom of the run here as well, adding into that, we've got this little value area, or say inflection point for lack of a better word, whereby this can come in and this can be the first inflection point. This can actually start to turn around. That's the only element, barring the other thing as well, that made this position slightly higher risk. This was around 5 a.m, 5:15 a.m. What's funny, this was yesterday. Every day I'm up between 5 and 5:30. Out of all days, yesterday was the day that I woke up a tad bit later, getting to sleep at the same time. Again, some of these things you can't control. I don't use an alarm as well. I haven't used an alarm in over 2 years, and I've been waking up just fine between 5 and 5:30 almost every single day, give or take. And today, or even yesterday, I woke up at 6. I didn't want to set a limit order because, again, I would have been at break even at that point anyway, as we can see around down there. So the last thing I want to do is get involved in this mindset of chasing trades, and then this pulls back and tags me out where I would have been at break even anyway. So you can't get in that mindset. If trade goes, let it go. It is what it is. You don't need to run after it. You're not a slave. If you try and trade the market like a slave, you'll get paid a slave's wage. So this trade would have actually taken me out now for about 3.9 or even 4% roughly. That would have been a nice position. Final two positions on EJ. These are absolutely lovely. Now this is something that can get tugged under the blanket very easily, and it's a little bit more difficult to see. But like I said, when you train your eyes to see the market through one lens for a very long period of time, you see things that many people cannot see. I've been trading the Falcon Wave for 5 years this April coming. How I trade this system now, how it's allowed me to view the market now compared to last year, the year before, year 1, 2, 3, and 4, is so different. The trades that I see now are the same trades but in a different light. My eyes are trained to see them better. It's sort of like you get this superpower, you get this sixth sense. This is why I always encourage traders to stick to one system and master it. Get as good as you possibly can get at that system. Because if you're changing and swapping systems all the time, the way by which you view the market, the lens by which you view the market from, is going to change so frequently that you're not even going to know what you're looking for half the time. So you need to train your lens effectively by trading one system, and you get better and better and better. I know traders to this day that still trade support, resistance and EMAs, and they're making far more money, and they're performing far more better and well than traders who supposedly trade like a bank, okay, which is an absolute facade in itself. So a little bit more difficult to see, but I'll break it down. It's very simple. So higher time frames, we've got this potentiality of this channel forming. In the middle of that, we've got this huge middle section. On the way down, as we can see here, very interesting. Wick, wick. Impulse, correction, continuation to potentially fill that and then come higher, as we can see here. Even if it isn't, this would have, if it was going to go long, formed a very clear-cut continuation to go to the upside. Now it still can break out and do that, but the short is still warranted because this room here, this sort of near miss, is very potently sort of obvious to get filled. Now if this came into this point here and this was truly a value area, it would have sunk into that, broke up, back higher again and formed a continuation pattern to go higher, but it didn't. So you've got to take a message from the market. Now what can we see here? Small little near miss. 1, 2, 3. This looked very prominent to fill that. It didn't. Instead, what did we do? So instead, we tapped into this override area, as we can see here. We gapped. Now, what do we know about gaps? Say around 75% of the time they are filled from a rough statistical basis. In this case, what looked to be forming was this continuation, hence why I've got the ray line marked on. So I was looking at this to break back in, and so on and so forth, fully well aware, and this is a very, very effective pattern. When you have a continuation, whether it be a 2 or 3 touch, most of the time it's 2 touch, and you have a crystal cut clear bear flag forming either before the low or at the low, these have a very high potency to break out to the downside, extremely high. They're one of my favorite traded setups. I've mentioned this many, many times in webinars as well for those guys who've attended and seen me say that. Very, very interesting patterns here, and I absolutely love them. So the context for this to go long was actually fantastic because, as I said, the name is to be filled, this area to be tagged, break out, head and shoulders formation to break back down, etc. Whatever it might have formed. So that long was very, very prominent. However, we formed this. Now, the only thing that made the initial entry slightly higher risk was when I filtered down to the 5-minute time frame, we have this hook point sat right above. That's the only thing that adds the risk onto this trade. However, because of the efficacy of the pattern that I spoke about, I would have taken this trade regardless because I can afford the risk, hypothetically. If I could afford the risk hypothetically, sorry. If not, then the better entry would have actually been in here, but only as a scaling. And now this is an important point that I want to break down here, that many, many people get confused. If I was to take this scaling as an initial entry, what do you think that does to the overall risk? Look at where we're positioned. Even with the risk entry, I'm not managing on the 5 or 15, I'm managing on the 1 hour. And on the 1 hour time frame, I can't get to break even by the time this value area inflection point is met. So the only thing that would warrant the scaling is the initial entry. So you've got to calculate the risk and see, right, overall, is it worth it? Well, if over here you can lock in, or let's say even be at break even, even if you were to lock in 1%, let's have a look, because I've not actually looked into this. I'm looking into this raw right now with you guys. So let's have a check, and I'll explain my point in a second. So we would have been running about 3.2. I'm not bothered about running profit actually in the end. It's more so around structure points. Have we broken any? What can we do? Can we lock in any profit? We've not really broken much. We're still in an exhaustive bit of price action here, so locking in profit would be pretty stupid. There's no point me locking in 1% when this can literally just tag you out for 1% and drop. You know, we've not actually broken structure. Now I would have locked in profit, which is a different story because we have broken structure. So if anything, I would have been at break even for this trade, and the worst case scenario, take a 1% loss instead of a 2% loss. So can I afford that high risk entry for the potential of tripling or doubling my risk to reward? So as you can see, I would have been running around 10. Forget running, let's have a look at locked profit. I would have locked in just above this area here. So say 6%. I've doubled my risk to reward potential by only adding in the same amount of risk that I would have taken anyway, if that makes sense to you guys. So what I mean by that is, had I have taken both these trades with full risk open and not able to manage the first one, that would have been 2% risk exposure. Now my max risk exposure is 1%. So the fact that I can get this to break even, and this is already at break even before I'm scaling in, I'm still not exceeding my max risk exposure with the same potential also to make double the return on the trade without the risk being compromised. And that's brilliant. That's how we play the market effectively with proper risk management. So the initial entry would have been slightly higher risk because of that mini little hook point. But again, because I've traded this pattern so much, this particular sequence, and I can get the risk entry here, you've got to ask yourself something. Is the risk worth taking? Number one, how do you know it's worth taking? And are you going off a whim? Most traders think, oh yeah, this trade is brilliant because they may have seen it once, twice, or 3 times in the past. There's a big difference between seeing a trade play out 2-3 times, but you can't really judge its probabilistic efficacy, and actually seeing a trade play out dozens and dozens and dozens of times, so many times over, where you can gauge the risk far better on that trade. So this would have been exactly that for me. As we can see here, 5-minute crystal cut clear, got exhaustive final leg, evening star formation right at the edge of structure there. The 15-minute has closed at that area, the 5 minutes closed, everything is there. The only negative is the hook point. We are a sizable range away, we're not too close, but you've also got to ask yourself as well, this is why forecasting is really important, is what would warrant price action breaking out and then breaking back in again when we've actually come down, we've accumulated enough volume here as we can see to complete at least that leg. Why would it need extra liquidity, extra volume from this area? What are the chances of that happening? What's the range away that it is? And all these different factors put into play, allow you to gauge the risk on the trade far, far better. So hopefully I'm not confusing anybody there, but that's the way I looked at that in the moment, or would have looked at that anyway. And then the risk entry on the scaling would have been warranted easily because of the risk exposure element that I talked about. And as a side effect, you'd be walking away with minimum 12%, if not more. There's no reason why this should hold back, because we've got nothing on the left holding it back. So if this does drop down to here, then we've got, and this is where I would have manually closed, 20 and 23%. It's easy 43% done. Now, we don't get trades like this all the time, and we don't need trades like this all the time to make a lot of money. It's very important to understand that. You can get trades like this, scale up your account, and you can give it back the next month if you're not a properly well orchestrated trader. Believe me on that. A lot of traders think just because they made a lot of return in a quarter that they're set for the rest of the year. You can have a great quarter and then you can mess up the entirety of the rest of the year. The true profitability is really measured over the course of 12 months, as a minimum at least. Very important points there. So hopefully I didn't baffle anybody's mind explaining that. Like I said, I was looking at that raw with you guys as well. I'm literally just checked this morning and actually logged this in as 2 trades that would have taken in that exact sequence mentioned. So yeah, we don't script things around here. This video is not planned. It's not scripted. It's 10 a.m. here, getting ready for some calls in the day, fresh at the charts. I thought, let me record a video for YouTube, a little bit of a trade breakdown as well. And yeah, I'll be doing a trade recap for you guys as well at the end of this quarter. All trades I took, trades that I missed, trades that I lost, won, everything. I'm looking forward to that. And in the meantime, smash out the week. Take care, guys.